Hello there. I hope that you're doing well. In today's lecture, I will share with you insights on the topic of time cycles and market fluctuations. I recently released a lecture in which I introduced the theory behind time cycles and their importance on market swings. When the lecture was released, I received many DMs of people taking trades based on the information that I provided. These trades were taken across not only the index futures, but also across the forex pairs and even on the crypto markets. Some people even applied this theory to trading gold or silver. That right there shows that time cycles work across all financial markets. If you did not watch the prior lecture yet on this topic, I would highly advise you to do so. During this lecture, I will expand on the knowledge provided during that prior lecture. Let us begin with today's lecture. We will first take a look at the following quote. Time is the foundation for market movements. Meaning, the algorithm delivers price based on a time delivery profile. This means that when the time is right, all of the price patterns that make you get into, for example, long positions or, for example, into short positions can be profitable. But when the time is not right, it means that the market will run against your positions. Therefore, it's very important to understand when the time is right for the market to be repriced higher or lower. You might be wondering, how could we potentially know when the time is right? That is where algorithmic signatures come in play. We believe that there are algorithms in control of the delivery of price. If you do not believe this, or if you hold on to the idea that all markets are random or that supply and demand is in control of these markets, please just try to listen to this lecture with an open mind and research and investigate what I'm about to share with you. Don't take my word for anything that I say during this lecture. I want you to go into your own charts and I want you to investigate the fluctuations of financial markets based on what I'm about to share with you. And it doesn't take long for someone to then realize that there's a repeating phenomena based on time and price. During the previous lecture, I shared with you the importance of understanding that the current time cycle determines how the next time cycle is likely going to deliver. When we are in a new time cycle, the first algorithmic reference points that we have are the previous cycle high and the previous cycle low. Above the previous cycle high, buy-side liquidity is resting, and below the previous cycle low, sell-side liquidity is resting. When we understand these reference points, we can monitor the reactions to these levels. The reactions to these levels will be crucial for determining what's likely going to happen next. During the previous lecture, I shared with you that the highest probability trade setups are the following. When during the current time cycle, if the underlying order flow is bullish and we're anticipating higher prices, that the market will seek to open up, reprice below the previous cycle low, take out of the sell-side liquidity to then revert towards the previous cycle high. This is a purge and revert model in a bullish environment. In a bearish environment, it would look like the following, where we are anticipating lower prices for the day or for the session based on our higher time frame analysis. We see the new time cycle open up. We see the market run up higher, taking out the previous cycle high. And when we take out the previous cycle high, we see the market purge the buy-side liquidity resting above that high to then revert towards the downside. IPDA will now seek to attack the previous cycle low. This is a key sell-side liquidity pool. This is a purge and revert model within bearish environments. What is very important to understand, however, is that if we do not see this purge and revert model playing out, another model is playing out. The model that is then playing out is the following. It's the continuation model. In bullish environments where the higher time frame order flow is bullish, we can see the current time cycle open up, reprice above the previous cycle high, and instead of drawing towards the previous cycle low now, we see the market retrace into the previous cycle's high, its respective price level, find support there, and then expand towards the upside. This occurs when the underlying order flow is highly bullish and we're anticipating higher prices. In bearish environments where we're anticipating lower prices, we can see the following take place. where we see the market opened up, reprice below the previous cycle low, retrace into this previous cycle low its respective price level, find resistance there, and then continue towards the downside. You need to understand, guys, that it's always one of these two scenarios. It's either a purge and revert of the previous cycle, its liquidity, or it's a continuation model where we trade below the previous cycle low and we expand lower and utilize that same level as resistance on price. Or where we displace above the previous cycle high, retrace into the previous cycle high to then expand higher. This is crucial information. And what I'm about to share with you is the application of these two variations of utilizing time cycles.
Any other day, any other time, I'll be on my way. There was a time where you tried and you said, why would you fight what was inside? That wasn't part of the plan, now I know there should go. Looking for some reasons, tell me there's something wrong with it. Tell me there's something inside that I need. You know I'm not gonna stay the night. Oh, I just need one reason, I know there's nothing wrong with it. Hard to pretend it's not what I want. Way too close to read my mind.
I know you got your reasons, yeah. I know the meaning. I know you're still healing, babe, but you're still appealing. Hope you don't think I'm reaching, but I got feelings to the ceiling. And I'm still in my feelings, yeah. You know you're very well seasoned. I know you got your reasons, yeah.
You have just seen me go short on Nasdaq during the morning session based on the continuation model. I will now break down this setup to you and I will explain to you the overall logic that was utilized to frame this continuation trade. Even though this was a continuation trade, we still go from the higher time frames all the way to the lower time frames in order to determine when a continuation model is likely going to play out. So here we're on the daily chart of Nasdaq, and as you can see, Nasdaq has been repriced towards the upside aggressively throughout the past few weeks. Nasdaq repriced above this buy-side liquidity, which was resting above this high, and we traded into this daily CB right here. My mentorship students know that this was my drawn liquidity on the upside. When we reach this drawn liquidity, we are going to pay attention to how we're going to react off that very specific range. I went short on Nasdaq inside of the delivery away from this daily CB's price range, and that is what you will see on the lower time frames now. If we go into the hourly chart, what you need to see is the following. You need to see that on Wednesday, during the afternoon session, the market began to reprice towards the upside. This expansion continued throughout the Asia session and throughout the London session. When Nasdaq then was repriced into the daily CB's price range, this green box, something interesting occurred during the morning session. At 9:20 AM, Fed Chair Powell began speaking, and what we saw occur was the following. The market took out the buy-side liquidity resting above this high, and it then began to slam towards the downside. When I saw the market then trade outside of the range of that green box, of that daily CB, I knew that the next candle would likely distribute towards the downside quickly. Why? Well, who has been making money all throughout this leg higher? Buyers, of course. Therefore, a lot of people are in profit on paper, meaning their open positions are experiencing unrealized profit. Therefore, a lot of sell-side liquidity is engineered below all of these lows. We can logically anticipate that if they will seek to draw towards all of this engineered sell-side liquidity, what is a key drawn liquidity then? To me, the midnight opening price is a key level to target then. And what I liked about this midnight opening price was the fact that there was a BC, a fair value gap, below that midnight opening price. If we then go into the 1 minute time frame, you can see my executions right here, as you saw within the recording as well. I'm going to break down this full delivery with you, so don't worry if you do not understand the logic behind this setup just yet. Trust me. These fluctuations right here might seem random to you. It might seem like, oh, we're just in a downtrend and the market is just being sold off aggressively. A lot of sellers are stepping in this or that. And honestly, it goes way deeper than what you might imagine. There are so many fine details that are present inside of this delivery based on time and price that you can only see when you begin to investigate these signatures. And in order for you to be able to investigate these signatures, you must first understand them, and that's what I will explain to you. First of all, what we can see is the following. Here I've added some annotations onto the chart, and we're going to begin with this reversal right here. As I outlined, Fed Chair Powell was speaking in advance of the 9:30 open. We saw the market turn around and we saw displacement towards the downside taking place, where we saw CBs get created. The market expanded towards the downside right here, and you saw this big CB get created in advance of the 9:30 open. The market retraces into that CB and it trades away from that. 9:30 comes along and it opens up, reprices higher into that CB and immediately slams lower. When you see that at 9:30 and you have reached a daily CB on Thursday, what you can logically anticipate is that we're likely going to attack that sell-side liquidity next. Why? Who has been making money all throughout the day thus far? Buyers, of course. Therefore, a lot of sell-side liquidity has been engineered. IPDA will seek to target all of this sell-side liquidity because the market cannot go higher forever. At some point, we need to attack sell-side liquidity before we can potentially either continue higher or turn around completely. What we see is that at 9:30, the market begins to reprice towards the downside aggressively, and between 9:30 to 10, the market is trading inside of the lower end of that daily CB, of that green box, as you can see. Notice that we create this BC and the market reprices into this upclose candle. When the market reaches this upclose candle, it finds resistance there and then slams towards the downside. At this moment in time, we want to see this BC function as resistance on price. If it does, that's to us the signal that this BC is functioning as an inversion to value gap. This signals weakness on the market. Why? Because it shows that all of the discounted rates that are being created are getting violated and begin to function as resistance on price. Order flow is bearish. What we see is that the market consolidates in the lower end of that daily CB right here, and then 10 o'clock comes along. 10 o'clock is the open of a new 90-minute cycle, as I outlined it within my previous lecture, in which I explained the 90-minute cycles of the morning session. What I want you to see is that at 10 o'clock, we open up, reprice higher, and trade into that old BC, and we immediately reprice towards the downside. We trade below this low, and we trade outside of the range of that daily CB. The market reprices higher and it retraces. In what does it retrace? Into the upclose candle, which set up the displacement leg below this low. Why is this low so important? Because this low right here was the low of not only the previous 90-minute cycle from 8:30 to 10 a.m., but also of the time cycle of 9:30 to 10 a.m., aka the first 30 minutes of trading from the 9:30 open. As long as the market does not displace above this upclose candle and above this downclose candle, order flow is very bearish. And we can anticipate that high frequency trading algorithms are doing one thing inside of this range. That is shorting and shorting and shorting and shorting. Why? Because the underlying order flow is so bearish, and every single key level that should function as support on price if the order flow would be bullish is getting displaced through. Therefore, in order for us to get in line with the underlying higher time frame order flow, what we need to do is we need to wait for the market to retrace into a premium of the short term, a premium of the range that is established. This is very advanced, but my mentorship students are smiling right now because this has to do as well with balanced price ranges. They retrace into that upclose candle, into that daily CB one more time, into that green box, and what occurs? The market begins to reprice towards the downside. Every single premium rate that's getting traded during that leg lower is functioning as resistance on price. Why? Because the time is now right for IPDA to seek to reprice towards the midnight opening price aggressively. But here comes the thing. This lecture is about time cycles. It's not about premium rates, it's not about discount rates. No, it's about time cycles. And you are probably looking at this right now and you're like, how the hell do time cycles play a big role in this? What you need to understand is that because we open up at 10 o'clock and we reprice towards the downside trading below this low here, the low of the previous cycle, of both the 90-minute cycle as the 30-minute cycle, we need to see that low function as resistance on price in order for the underlying order flow to remain bearish. If we then annotate this downclose candle, what you can see is that the market retraces and reprices higher into 50% of the downclose candle. The wick taps it right here. That's where I went short, and immediately slams towards the downside. When the market then expands towards the downside, we can see that in advance of 10:30, the market reaches not only the midnight open price, but also the imbalance which formed below that midnight open price. For me, that was the setup done, and that is how you're able to frame a high probability trading setup within just a few minutes of time. Meaning, within around 15 minutes, this setup was done. You have just seen the execution video of the long that I took during the afternoon session on the same day. Here we're on the RE chart again, and what I want you to see is the following. I want you to see that the morning session expanded away from that daily CB price range, the green box, and we expanded into this BC right here. This BC is to me the most crucial reference point for Nasdaq right now. Therefore, as long as Nasdaq does not displace below this BC, I anticipate us to be range bound inside of this range. What I saw during the afternoon session was the following. I saw that the market failed to displace through this RE BC price range, and I saw that we formed this RE CB. Next to that, I saw that we were trading below the midnight open price and below the 9:30 open price. Therefore, I knew that Nasdaq was in a deep discount. All I had to wait for was the following. I had to wait for the signatures to confirm to me that NQ was likely going to draw towards this RE CB price range and attack all of the buy-side liquidity engineered during this massive sell-off, or during this massive run lower, I should say, because it's not buying or selling pressure that's making the market go up or down. If we go into the 1 minute time frame right away, you're probably like, Zeus, why are you going from an RE chart all the way into a 1 minute time frame? Look, all I care about is the following. I need to know of what key level IPTA is likely going to react, in the sense of, okay, where are we going to form the swing high or swing low? When I understand this and I see this, all I need to wait for is for the time to be right for the market to begin to draw towards the opposing side of liquidity. In this case, buy-side liquidity. Where you saw me initially go short during the morning session because I was anticipating lower prices, you can see that I now went long during the afternoon session. Here you can see the executions, and this delivery is probably going to be pretty hard for you to digest and to investigate. However, I want you to pause the lecture for a moment. Really just press on pause, yes. And I want you to investigate the delivery here. Try to break it down for yourself and really try to pay attention to time and price. Don't only look for a bullish break or a bullish or value gap. No, look at why I entered where I entered. How did I know that we were likely going to draw towards buy-side liquidity? How did I know we were likely going to reprice towards the upside? Pay attention to the time on the bottom right here and try to divide the time into the 90-minute cycles as I've taught. Please pause the recording because you're missing out else on this learning opportunity. I'm going to break it down for you now and I'm going to add the lipstick to the chart. If you did not pause the lecture, then it's your fault, and then you shouldn't be surprised if you do not get the full benefit of what I'm about to share with you. Here I've added my lipstick to the chart, and we're first going to pay attention to the time aspect. I know that there are a lot of annotations right now in front of you, but I'm going to walk you through it step by step, so don't worry. First of all, I put a vertical line at 11:30 for the afternoon session. 11:30 to 1 is my launch cycle. That is for me the most crucial range when it comes to trading the afternoon session. When I'm interested in trading the afternoon session, I first need to know where's the launch low and where's the launch high. In this case, the launch low formed right here and the launch high formed right here. What I then saw was the following. I saw that at 1 p.m. we initially ran up higher, formed this high, and then dropped towards the downside aggressively. Notice, however, that we did not take out the sell side liquidity resting below this low. This low was the morning session its respective low. But here comes the thing. We are now in the afternoon session. So if we do not take out the morning session its respective low, and we see the market instead find support inside this bullish rejection block, that right there is a key algorithmic signature. Why? Because it's showcasing to us that this morning session low is allowed to stay intact. If you pay attention to inter-market relationship, you will see something interesting occur as well on the ES. For those of you that are putting in the work. By trading into that bullish rejection block at 1:19 p.m., the market has taken out sell side liquidity resting below these relative weak lows. These were the launch cycle lows. Therefore, this run lower can be considered to be manipulation. The market displaces towards the upside and we displace away from that blue box at REBC. The market then trades above this down close candle, and we see the market retrace into that down close candle and find support there. This is where I went wrong. Why is the market finding support inside of this down close candle? Pay attention to the time now. This down close candle was the high of the previous 30-minute cycle. So when 1:30 p.m. opens up, my eye immediately goes to this high. This is the previous cycle high of that 30-minute cycle. Therefore, we are going to see whether or not that high will function as support and price. Why do these imbalances get left open, you might be wondering? Because there's absolutely no reason for IPDA to retrace that deeply. It's in a rush to reprice towards the upside. The time is right for the market to begin to draw towards buy-side liquidity, resting above all of these highs here. You can literally draw a trend line above these highs, and you can see that every single retail-minded trader will think to themselves, well, the market is very bearish, therefore we should go short. We can place our stop loss above that trend line, and that is engineered buy-side liquidity. IPDA will seek to attack this buy-side liquidity. The market retraces into that down close candle, into that previous cycle high, and what do you see? 50% of that previous cycle high is right here by these dashed lines right here. Notice how the bodies are respecting that level. The wicks go below it, but the bodies respect that level. Time distortion is taking place. This is irrelevant price action. Time is sprinting, whilst price is just going up and down inside of the same range. And the market begins to expand towards the upside. The time distortion ends and the market begins to expand towards the upside. I begin taking partials inside of a premium of the range from this high to this low. And my partials were rather nice in my opinion, because you can see that the partials took place on the highs of these retracements. What we then see is that at 2 p.m. the market begins to reprice towards the upside again. We see a BC get created, the market retraces into this BC and it finds support inside of that BC. We trade above this candle's high, and this candle's high is the high of 1:30 to 2 p.m. Therefore, between 2 to 2:30 p.m. we are going to refer to this high. The market trades above that high, and notice how that high is now functioning as support and price. The market then begins to spool towards the upside, and this is where a quick low resistance liquidity run is taking place into that previous 90-minute cycle with respective high, or into the launch cycle high. But here comes the thing, guys. Do you see that the launch cycle high was the low of that early imbalance? That right there is a key algorithmic signature. But what I want you to take away from this overall breakdown is the following. Do you notice how inside of this breakdown, I literally explained to you the Persian referred model, but I also included the continuation model to frame the entry. Yep. Guys, this is how the market moves. When you start paying attention to time cycles, their respective high and lows, and you pay attention to the reactions to those respective high and lows, your mouth is going to fall right open. And if this video has not inspired you to investigate this, I don't know what will. Before we end with the lecture, I'm going to dive into the 15-second time frame with you, and I'm going to share with you why I entered where I entered. Here on the 15-second time frame, and what I want you to see is the following. I want you to see that on the 15-second time frame, the market repriced above that previous 30-minute cycle with respective high on the 1-minute time frame, and we retraced into that range. Notice that the market never was repriced below that range again. We see a CB get created, and that CB can be utilized as an inversion for value gap. Why? Because the underlying order flow is bullish. Therefore, premium arrays that get created are likely going to get utilized as inversion arrays. The moment price trades above that CB, to me, that CB is now going to function as support and price. IPDA will seek to reprice into that CB and offer smart money the opportunity to go long. Why? Because the real draw liquidity is at this blue line, at the previous cycle high, at that launch high. Therefore, we can go long anywhere inside of this red box, and to be more precise, inside of this CB. If we pay attention to time more, you can investigate what is occurring inside of this red box. There are some key algorithmic signatures present there. The market begins to reprice towards the upside, and I partialed accordingly. These exits are of course very nice in my opinion, because I exited at exactly the high of the retracements. Slow expansion towards the upside, but after 2 p.m. you can see that the market begins to reprice towards the upside aggressively. With that being said, this lecture comes to an end. I hope that you found it insightful, and I hope that I was able to inspire you to investigate time and price to a greater extent. I hope that you will be able to go out there and research everything that I shared with you. If you find any repeating signatures, tag me on Twitter and let me know what you have found. I'll be happy to see whether or not you have found anything of value. I wish you all the best and good luck with your studies. Be safe.